We talked last time about how you are really a bottoms-up type of person.
Yep.
When you look at all of this, the market, but your big call is really a top-down view of what's happening.
Yes and no. I am a bottoms-up person, fundamental analysis, peaking each stock up based on its own merits, but I've always used a top-down blueprint based on sentiment in the market, the economy, the market activity, et cetera. So I try to mix both. I'm proud to say that I really never lost much money in any of the down markets. But, I do have thoughts about the very long term, and I think economic conditions in this country are really good and likely to stay that way. Secularly, over the next 10, 15 years, I think inflation is low. We have disruption that's ongoing. We have competition, the Amazon. Wage inflation's ticking up a bit, but I think overall inflation's going to stay well contained. You put that together when you look out 10 years, that's a great environment for stocks. Now, again, there will be cyclical bear markets and corrections. Maybe we're in the middle of one now. We probably are. But it's a good long-term outlook.
For the long term, obviously, you're taking a broad range over an extended period of time. But we've just been having this conversation. We were having it in the last block, and we've been having it for months at this point, about whether the Fed was making a mistake by continuing to raise interest rates in December. What do you think about that? Could a policy mistake throw off what you've been expecting?
Oh, for the long term, it'll have no effect on that. It may cause a little more volatility, a little more ups and downs in the short term. First of all, I say it's irrelevant. That's past history. Let's look forward from here. The Fed has already said they're not going to, they're going to be a little bit more dovish going forward. Second of all, kind of what happens to some extent. And 25 basis point, did that make all the difference? I don't know.
All right, let me ask you then, just the sell-off that we saw, did that make things look cheap to you if you're suddenly talking about 14 times forward earnings?
I would say, and that was the other factor I was going to mention, the market is very reasonably priced now, the best it's been in quite a while. And I can tell you on December 24th, the market looked very cheap that day.
I got really excited just now when you talked about disruption and sort of confirmed what I'm hoping for, that these great discoveries are coming quicker and quicker.
Yes.
Whether in AI, God knows when computers and when machine thinking suddenly outpaces human thinking, I mean, it seems very deflationary to me, which makes me think we could explain a new normal for where interest rates are supposed to be that might take the Phillips curve and turn it on its head, that you don't necessarily, that great growth doesn't necessarily come with inflation, and therefore you
bullseye.
Really?
And I absolutely believe that, and I've said it for I've said for 5 or 10 years, interest rates are going to stay low for longer than we believe. Doesn't mean the 10-year won't go up to 4%. It does mean it's not going up to 6% and 7%. This disruption and innovation is very deflationary. Consumer staples stocks, consumer staples companies, that's a big part of the economy. People purchase them. They are under pressure because Amazon is now selling these goods private label at much lower prices. So this ongoing deflation and disruption is going to continue, keep inflation down. It gets better than that. We do have tight labor in this country, tight wages in this country. I actually believe we're going to have a sustained period of higher wage growth. We're about 3 years into the trend of lower income people having less wage growth than upper. We're 3 years into a change in trend there. So it's going to take a while, but the inequality, which has been a major issue, it's going to get better over the next 10
without
to 15
inflation
years.
Because that was the worry, without hurting profit margins. Andrew, as a doorman, you weren't worried about the income inequality that much, right? Because you're not worried about the revolution. No, I know.
You stole that line.
I stole that from Blankfein. Yeah, I did.
But you're right on, Joe, with that. Exactly.
Where are you on retail?
You're so smart, Jeff.
Where are you on the retail industry, not retail stocks, but the retail industry? You made some comments earlier.
I am bullish on the consumer, long term, and frankly, short term, I'm bullish on the consumer. That's not to say that I'm necessarily bullish on individual retail stocks. You have to be so careful because obviously Amazon and others are really hurting them big time. So brick and mortar retail is under pressure. But again, if you look at the consumer looking at over 10 years, first of all, unlike 10 years ago, the consumer does not have too much debt. They've reliquefied. Second of all, wages are going up, which over time is going to be a big positive. Third of all, oil prices are down. Fourth of all, you have all this disruption I talk about. This is more money in the consumer's pocket. But it is really tricky where to invest that because it is good for consumer spending, but there's so much disruption that individual stocks, you got to have a professional picking the right ones.
So given that pretty bullish outlook on the economy, as you
long term. Next 6-12 months, I don't know.
But as you construct a portfolio now that you're back in the hedge fund business, are you net long, net short? How do you kind of construct a portfolio with that outlook? Where are you bullish and where are you bearish?
I think that long-term vision is very important. When I construct a portfolio, I probably have a year or two horizon in general when I do that. So based on the conditions at that time, and I'm very much, I don't try to predict the future, even though we are predicting the future, and I do have those beliefs strongly. I don't try to predict the future short term. I watch the cards come out of the deck. So, if and when we're back in business, it'll be the conditions at that time which will dictate what stocks I'm in and how leveraged the portfolio is, or am I in a lot of cash. It'll all be based on the conditions at that time. I can't predict that a couple of months in advance.
Can I just ask you back to retail and back to Amazon and how things are changing just from a broader level? We had Steve Sharippa in earlier, the former Sopranos actor who's now selling tomato sauce. He used to be going through the grocery stores, but now he's doing a lot through Amazon, and he says that that's the best. He said the grocery stores are like the mob bosses where they really crack down on you, and he could do much better through Amazon. How do changes like that kind of ripple through the retail industry and the consumer business overall?
Well, it's exactly what we're saying. It's tremendous ripple that goes through because now there are these alternative channels of distribution. There's unlimited competition. Anybody can sell on Amazon, but there's only a certain amount of shelf space out there at supermarkets. So it's more competition, more supply. It's great for the consumer. They see more products. All very good for the consumer. It's tough for the retailer. It's tough, brick and mortars, and it's a little bit tough for the companies because they're going to have more competition than they ever are.
Margins just get decimated.
They're going to be under margin pressure. Perhaps if there's something negative about my positive long-term, my 10-year long-term outlook, you have to be so careful with companies because if wages are going up as part of the economic pie, that could come at the expense of corporate profits. So companies are going to have to be focused on productivity. Boom, that's technology they have to spend money on.
So many of your peers, I was just thinking of the A in Amazon, I think of FANG, so many of your peers piled into FANG. So, and there's been a huge, obviously, downdraft.
Yep.
Now, would you get in now?
It's stock by stock and situation by situation, but when I look at the universe of stocks out there, I've always said the following, 10% of companies are buys, 5% are sales or shorts, 85% are, I have no idea.
Okay.
You got to be honest. I can't.
But when you look at that screen, I don't know if you saw
hey.
There you are, but show the no. When you look at that screen,
okay.
How do you break that down? That list?
I see company. Facebook. You guys all see it.
It's
the FANG
the FANGs,
stocks.
yeah.
I think there's secular trends behind them all, but they have different fundamentals, each of them.
Right.
So you got to go do your work. But I could put a portfolio together and not have any of them in there for 2 years, perhaps, because the market is trillions of dollars. I want to focus where I have conviction.
What percentage of Vinik Asset Management will be devoted to Bitcoin? I'm just helping Andrew out here.
Thanks.
1%,
0%.
How about
Equities.
we got to stick with the current environment. How about pot stocks? Big owner of.
I won't say zero, but my guess is they're overhyped.
No.
There's going to be too much competition. Margins are going to come down. Nobody's going to make money. That's
Fair
my
to say,
opinion.
though,
Okay.
fair to say that technology is a big play because you just said all of these companies that are being disrupted, no matter who you are, you're
Yes.
going to have to be spending a lot more on technology.
That's why I said it. Yes. To be fair, we are in a little, in terms of cloud hardware spending, we are in a pause right now. We may see that with some of the December quarter earnings. It's affected semiconductor stocks, and it's affecting some of the hardware companies that sell to Amazon and Microsoft and others. So yes, bullish tech long term, but we're in a little bit of bumpiness right now.